Okay, you guys good down there? All right. Good morning, everyone, and welcome to the investment meeting for December 2012. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, representing Police Commissioner Kelly.
Barry Dennis, SIS.
Dan Torelli, PBA. Pat Andrew, PBA.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Turco, LBA.
Paul Giacomo, DEA.
Kath Martino, Controller's Office.
Yvonne Nelson, Controller's Office.
Barry Miller, Controller's Office.
Martin Gantz, Controller's Office.
Seema Hibarani, Controller's Office.
Ed McKeegan is here, Controller's Office, and Larry Schloss, Controller's Office.
Janice Emery for the Mayor.
Justin Holt, Department of Finance.
Bob Shensky, State Pension Fund.
Kevin Holloran, Pension Fund.
I'm Robert Fang, Controller's Office. Rick Victor Castro, Controller's Office. Evan Nonson, Controller's Office.
Controller's Office. Ron Cavanaro, Pension Fund.
Okay, Larry?
Okay. Thank you, everybody. Bye.
So, quarterly. How if you do it? We'll just punt on. Okay.
Martin, you want to start with the quarterly?
Sure. We have extra copies. Anyone need? Anyone else? Okay. Oh, I'm sorry. The September quarter, as Larry's been describing over the last few months, has been a relatively good quarter, and in just a moment we'll be talking about, Larry's going to be talking about the October returns. The returns were good despite the uncertain economic conditions resulting in the ECB in Europe and the Fed in the U.S. continuing with their market interventions, and this definitely had a positive effect. The Russell 3000 was up over 6% in the quarter and 30% for the one-year period. Non-U.S. equity did even better, with ETFA up nearly 7% and emerging markets nearly 9%. Fixed income also did well. Investment grade benefited from the Fed purchases, and high yield benefited from investors searching for higher yields. Overall, it was a very good quarter, and it's going to be very difficult to find negative numbers in this. In U.S. equity, by the way, value did a little bit better than growth, and large cap outperformed a little bit over small cap. If you turn to page 8, we have the total returns and market value for the entire police pension fund, which was valued at $26.7 billion, which I believe is a high. The returns for the quarter on the left, you'll see, is 4.41. Very high on an absolute basis, but 49 basis points behind the benchmark. The year, 12 months, was over 16.5% behind the benchmark. And I do want to point out that while the actuary is not here, the 10-year number is 8.46%.
Just a quick question. On the sheets we get from Bank of New York currently, how far out do they bring those returns? Was it 20-year, 29?
The standard returns, I believe, go out to about 10 or 11 years, but obviously we can have them produce.
No, I just thought they went out further.
No, I think it goes. I think it goes out to about 11. Yeah.
Okay. But the 10-year return.
10-year return is 8.46%.
I understand. So previously, when people were discussing changing the assumption rate, and they brought up a 5% number, that obviously has changed. So now we're up 8.46.
Right.
For a 10-year, going back from 930.
Correct.
Yeah. So if you select a 10-year period, depending on when you select it, you can change that number dramatically.
It's very end date specific.
Right. Okay. I just want to make sure.
The asset allocation. Any other questions? The asset allocation and rebalancing ranges are shown on page 9 and 10. Page 10 shows the rebalancing ranges and asset allocation for the adjusted policy mix, that is for the parking places. The asset allocation on the top of the pie chart is very busy because we have a lot of asset classes. There is a new asset class here that did not exist before, and that is bank loans. That's about at the 11 o'clock spot in what looks like a military green color. The Overweights and underweights, as you see, is all within policy, with the exception of tips, and we'll be talking about that in a little bit. The next few pages talks about attribution returns versus policy and how the managers did versus their benchmarks. Summary for the allocation effect, which is how the overweights or underweights affected the returns, is summarized on page 14. And for the quarter, there were only a few numbers that were meaningful, but the overall difference was a total of 9 basis points. For the 1 year and the 3 year numbers, as you know, we had a higher level of cash about a year ago, and we're underweight Core Plus 5. We were comfortable with this, and also a lot of these numbers are driven by the parking places themselves. For instance, the underweight in real estate, opportunistic fixed income, and hedge funds. And so whether we were underweight, the parking place classes affected the allocation effects. For the management effect on page 15, it's almost entirely driven, as you see, by the private equity, and partially that's a mismatch in timing, but it's also partially some underperformance. Pages 16 and 17 show how police did versus other large public funds. If you take a look at page 16, the most recent quarter, the bars, the blue bars, are the ranges of how high and low the funds that you're compared against did, and you'll see that the ranges were very, very narrow. While you were in the 63rd percentile, you were only 5 basis points away from the median at 441. The 1 year number, which is just to the right of the line in the middle, that's labeled September 12, the 1658 puts you in the 41st percentile, and you're above median for all the years ending September, except going back to September 08, so the last 4 years. The annualized numbers on the next page show a similar story, numbers that are above median for the 1, 3, 4, 5, 7, and 10-year number. And in fact, the 10-year number that we just talked about, the 8% number, is top quartile. Unless there are any other questions, I'm going to turn it over to Seema for any comments on the equities.
Martin, could you walk through just how these allocation effect calculations, what goes into those, if you happen to know it? For example, are these net or gross of fees?
These are all gross.
Gross of fees. And how does it account for, you mentioned the parking places kind of muddying the calculation. Does it account for drift effect? And
it does. It assumes that we should be at the allocation, including the parking place. So if real estate, 50% of the underweight in real estate goes into tips, it is assumed that the policy is tips, which I believe is 4%, plus that extra underweight, let's say 1.5% to add. Mm-hmm. So if we are underweight that, and tips does well, which it did, we underperform on the allocation.
Mm-hmm. Yeah, I noticed that domestic fixed manager selection was a plus, but allocation effect was a detractor. So
because in the beginning of the period there was an underweight, that underweight was mostly covered towards the end of the period.
Uh-huh. And the State Street short term, that's the proxy for cash?
That is the cash.
Okay. Let's see. And you get these numbers from Bank of New York? Do they calculate these, or is
Bank of New York does the calculations, yes.
Okay.
We review them.
All right, thank you.
See.
Okay. So if you turn to page 21, this is your domestic equity allocation. And as you can see in the pie chart, a lot of your allocation is passively driven. But I'll just point to a couple comments on the page. So if you look at the index return column, the actual return column, and the difference column, in the index return column, like Martin mentioned earlier, you can see the U.S. market was quite strong, as measured by the Russell 3000 index, up over 6%. And then if you just look in the difference column, I'll just point to one thing that stands out, which is the last row there under emerging managers, outperforming by over 100 basis points. You might remember that police voted to switch their some of the emerging manager fund of funds that were all cap into an all small cap mandate, which is helping out so far. So So far so good there. If you then turn to page 28, that's your international allocation. And if you look in the pie chart to the left, you're more balanced, active versus passive, but still, in this case, more active than you are passive. So if you look to the same three columns, the index return, the actual return, and the difference column, if you look in the index column here, you'll see that both the EFA, so the developed market index, up close to 7%, doing better than the U.S. If you scroll down to the passive EM, you'll see that the emerging markets were up almost 8%, so both of those higher than the U.S. in the quarter, so good numbers. And if you just focus on the difference column and you scroll down to non-U.S. activists, you see underperforming by about 400 basis points. We'll discuss that more in the executive session. If you look on page 29, the next page goes through some detail on EFA. And if you see there the trailing 3 months fiscal year to date, trailing 12, 3 and 5 year, police is the purple bar, and yellow is the index. So basically in line with the index over the last 3 months, doing a little better in the trailing 12, and again a little better in the trailing 3 and trailing 5. You might remember we finished the new EFA search, and so we will be funding those managers over the coming months. If you then turn to page 35, that goes through your emerging markets returns. And again, if you just look in the trailing 3 months fiscal year to date, doing a little better than the benchmark. Again, police is the purple bar and the index is the yellow bar. And if you look out over 12 months, roughly in line with the index. But importantly, we did the new EM search already earlier this year. We funded those managers. Those numbers are in the quarter for a full quarter. So so far so good there, a little bit ahead of the benchmark. If you then turn to page 37, this is the hedge fund portfolio. And again, these are still early days in our portfolio. But if you look at the trailing 3 months and the fiscal year to date, we're doing a little better than one of the benchmarks, roughly in line with the other. And if you look for the trailing 12 months, we just funded the directs starting January of this year, so we need some more data as we go forward for that number to start really showing how the portfolio is doing. And now I'll turn it back to Martin.
Thank you. If you turn to page 39, we have a summary of where your fixed income assets are invested. $9.3 billion are in fixed income, which represents 35% of the fund. I mentioned bank loans are new. That's also shown here in the roughly the 11 o'clock spot. The next few charts show performance of each of the sub-asset classes or the asset classes. Bank loans, we don't have a page yet because we don't yet have performance. The accounts were just funded. The largest of the programs is shown in light blue, which is 56% of the fund, and that's summarized on page 40, where we show that 20% of the assets are in the Core Plus 5 investment grade program. Under an overweight column, you'll see that we've been underweight the government sector, treasury agencies, and overweight the spread sector. In this particular quarter, that was additive to performance as it had the lowest returns. Spread sectors did well, and most managers did well overall, and that's shown on page 41. The returns for the quarter were 246, ahead of the benchmark of 204, which brought the one-year return to over 7.5%, over 100 basis points ahead of the benchmark, and the three-year number over 8%. And that three-year number of 8% was with a volatility of 3%, so it was very much a case of slow and steady returns. Page 42 shows tips. We talked a little bit about this, and we'll talk a little bit about it more in a bit. The returns were also positive as tips treasuries. The return was 224, 12 basis points ahead. For the year, the return was very strong at 933. This is not because inflation has yet shown up, but because there are two sources of returns in tips. There's inflation, but there's also the duration effect, the price of the bonds. If interest rates go down or real rates go down, which they did, the price of the bonds will go up. High yield on page 43 shows that the returns were 423 on the blue bar for the quarter, just slightly ahead of the benchmark of 412. A very strong absolute level of return for the year as investors sought high level of yields, or higher level of yields. Return of 16.99 behind the benchmark of 17.84, and for 3 years the return was over 12%. Convertible bonds on page 44 is more equity sensitive, and so the returns are a little bit higher, 4.56, pretty much flat with the benchmark, and the return for the 1 year period is 14.16 behind the benchmark of 16.47. We have a 4 year record of 9.44 behind the benchmark of 10.79. Page 45 is opportunistic fixed income. This is an area that's growing in the portfolio. The quarterly return is 4.32. Behind the yellow represents the prorated 10% return, and 100 basis points behind what the J.P. Morgan high yield benchmark plus 3% prorated is. For the 1 year return of 9.68, slightly behind the 10% and behind the high yield index, but the 3 year return was very strong at 22.35, ahead of both of the benchmarks. And unless there are any questions, Kathy is going to discuss ETIs.
Good morning. The ETI portfolio did well against its custom benchmark, which is shown in purple for all periods. And again, those returns are net of fees. Turning to your, the smaller of the two books, the collateral benefits are shown on page 6, starting there. You did make $8 million in investments through your multifamily lending program. Then I want to turn to page 8 and just let you know that the AFL-CIO Housing Investment Trust Hit Home program has actually ended. They had a 10-year commitment to New York City to give safe and reasonable mortgages to union members, system employees, and other municipal workers. And during that time, 271 loans were issued to police members. We are actually in talks with them to set up another Hit Home 2, hopefully, which will play a role in hurricane recovery. So that's any questions? Thank you.
So continuing on with the highlights for the real estate portfolio for the second quarter. In that same small book that Kathy directed you to, real estate begins on page 16. I'm just going to stay on the first page because I'm just going to give you the highlights. The market value of the portfolio is about $744 million. Our total exposure to the real estate asset class as of that time is $1.2 billion. There as a 6% allocation to real estate, as you know. As we stand right now, we're about 2.9 invested, 4.6% committed at this point. Large portfolio, 43 investments, and 30 managers. For the quarter, the performance was 2.8 on a net basis. That's an outperformance of 50 basis points compared to the real estate benchmark of Odyssey that came in at 2.3%. Despite what's going on in the economy, the real estate recovery is still continuing in the right direction. You're still able to buy properties at lower than replacement costs. New supply is relatively low. Occupancy rates are improving across the property types. And so that kind of is driving the near-term performance of what you're seeing in real estate, and in particular what you're seeing in the police portfolio, because some of the recent commitments that we've made, and we've made $225 million commitments just in 2012, and we'll talk about 2 others later on today. So those selections have been very good for the portfolio, and as you can see in the near term, the graph at the bottom where police is in blue and the benchmark is in yellow, you'll see the outperformance in the near term for the quarter, 1 year, and 3 year. In the outer years, we kind of see the challenges from the global financial crisis and the way the managers kind of addressed that, but we are coming back strong. Does anybody have any questions on the real estate portfolio?
Barry stepped away for the quarter. The update in private equity was sort of a boring quarter, but I'll let him come. I'll let him come back, and when he comes back here, we'll let you guys grill him for not being here. So let's finish the. That probably ends the quarter, unless anyone has anything else. And let's get to October. Everybody have one of these for October? I'm going to do October fast, because November was better than October, so it is what it is. Very nice, very nice. I guess the simplest way to get to October is first to look at page 32, which shows you that we're off the peak of last month, September, but again, as I said, November was better and December is also up, so we're probably currently at the highest level ever for the police pension fund. If you jump to page 39, you can see in the far left-hand column what happened in October, and basically the equity markets were down. Again, if you think back to October, it was before the presidential election, so people were uncertain about what was going on, so they took it out of the stock market. President Obama was elected. The first 2 weeks of November it went down, and since then it's basically gone back up. Don't worry about that a little bit. So if you look at page 40, you can see that it cost us 27 basis points for the fiscal year to date. Net of that, we're up about 4%. I think we're probably up about 5% now. But as Joe correctly points out, we have this fiscal cliff to worry about. Your guess is probably better than mine as to what happens. But it's not like we day trade the funds, so the reality is we're just sort of set up and we'll just kind of go through it. You know, whether they figure it out before the end of December, or they figure it out a day or two or a couple of weeks later, just for hysterics purposes. Ultimately, you'd like to think they're going to figure something out, and the markets will just kind of putter through it. That said, the economy overall is sort of on the mend. Unemployment's going down, housing starts are back. So, again, if you look at how we're set up on an asset allocation basis, we're set up pretty much as we're supposed to be set up. And you can see that pictorially on page 35. And with that, I guess I'd like to hand it over to Barry to talk a little bit about tips, about our ranges and tips.
Yes. When we initially set the tips range of plus or minus 1%, it was around a target of 3. That was bumped to 4 in the last asset allocation study. And then with the parking place designations, the actual tips exposure is approaching 6%. It's around 5.6. So it makes sense to raise that range, just sort of the law of larger numbers. And I'm recommending we double it to plus or minus 2%, sort of consistent with the doubling of the allocation. And that, you know, when those parking places are depleted and we're fully invested in real estate, that it should come down to a natural point of 1.5% on a 4% target.
Made sense to us. Any discussion about, do we need a motion for that? Yes?
To the
Yes.
extent that it changes the police allocation, we need a motion.
Yeah, it just changes the range, but which we sort of try to stay in.
So make a motion that we accept the recommendation by our consultant to change the range of tips per his recommendation.
Okay, so the range will be plus or minus 2%.
Second?
Second?
I just saved you 14 minutes.
There you go, 14 minutes.
Okay,
Move the marble.
we're moving.
I think it's 13 and a half.
So that ends the month of October. Unless there's any questions, November's better, and, you know, hopefully all don't fall off the cliff. A quick update on Superstorm Sandy, since we weren't here because we were canceled as a result of that. You should all know that BAM never closed, the controller's office never closed. We had continuous operation despite the fact that we had no heat or power over at 1 Center Street. We kept going. the week of Sandy, the cash desk raised $2.2 billion for the city, and we funded about $350 million of pension checks that week. So, again, other than the blowing a little smoke in the office, things were fine. We spoke to our managers. We had negligible impact anywhere. We talked to the real estate managers. Everything's fine, nothing substantial. A little bit of damage here, a little bit of damage there, but again, as long-term investors, no impact at all. We now track on a monthly basis, a little tighter, member needs, member payments, member borrowings, to the extent that people want to borrow from their pension fund, which they're allowed to do. We have to make sure we have cash around, so we're kind of on that. So really no effects in our operations or cash or the assets. We are looking at potential investments as a result of it. We're trying to find ways to use the pension fund to perhaps, again, we have to find managers, as you all know. So we're talking to managers about loans or additional real estate transactions we can do to rebuild the areas of the city that were impacted by the superstorm. And to the extent we come up with any interesting investments and ideas and managers, we'll come back to the board for approval, obviously. But we've kind of moved it. I wouldn't say we moved ETIs up in the portfolio, but to the extent that there's a need for capital, we have capital, and to the extent that we can make market rates of return, what better place to invest in the city?
Has there been any conversations? Obviously, have there been any conversations, and I'm sure there's probably some in the mayor's office, about possibly hardening some of the city infrastructure against future storms like this? I think the governor talked that this may be the new norm, and if that's the case, then maybe this might be some sort of infrastructure type of investment in the future that we should be looking at, that would possibly put New Yorkers to work and protect the city in the future. Is any conversations like that occurred?
We haven't been a party to those conversations. I know a lot of conversations have been happening about how to re-examining what happened and what to do going forward, but we're just not a part of those conversations.
Any preventive measures at this point that have been discussed would be from tax dollars, not corpus funding. Any preventive measures discussed, would be coming from tax dollars, not corpus funding from the funds.
All right, I'm just thinking, kind of off the cuff, is that maybe these conversations need to be broached only because we have a vested interest in the city. Obviously, the tax base is important to this fund and to our members. And
although, how do we see that as an investment? I mean, I understand that we do need to protect the city and protect the residents, but here in this fund, I think we're concerned mostly with investing and getting a return. So it would need to be in that context.
Well, that's what I mean.
Yeah.
It's some sort of infrastructure type of an investment where we would be looking at maybe some partnership with government and hardening some of the assets of this city. And obviously, infrastructure helps protect the economy, and at the same time, it also puts people to work, especially here in New York City. So it's some sort of investment that might be interesting to the pension funds to look at. And if something could be developed, it might be helpful in the future.
And I think, Larry, can you clarify for us, Larry?
Yep.
How we would go about investing would be through external managers versus in-house? Because it seems to me we don't have any capabilities in-house today to be doing direct investments.
A couple of things. As you know...
By the way, not to get a whole program on the record now, but just kind of off-the-cuff thinking that, preliminarily...
Well, I think what Janice was sort of asking is, as you know, we invest, everything we do is in funds or with managers. So to the extent that there was a project in the city, a dike, the pension fund itself wouldn't have a way of analyzing if it was a good investment or not to invest in a specific project. That said, and we're going to talk about the IPS for infrastructure next, to the extent that we were up and going, we had an infrastructure program, we have 2 people on our infrastructure team, we pick infrastructure funds to invest in. To the extent that one of the funds thought it was a good idea to invest in the New York City project, that's how we do it. They would do it like that. Similarly, to the extent that if there was a big infrastructure project that used debt, I would think that one of our debt managers might do it. We might end up investing in infrastructure debt fund, and they buy a piece of it that way. But until we sort of get set up with an internal management team to analyze individual investments, we're kind of in the fund business.
Now, that doesn't prevent us from, or your office, or maybe some group of us, from engaging managers to make some sort of specific fund that would do something like this.
Yeah.
Something that we've done I think we've done the Erasmus Fund. Of course, they had its own problems, and we had to get out of that. But something along those lines, we could engage managers to create a specific fund that would just do specifically this for us.
We could, in fact, it's very much like the real estate funds we're looking at investing in that are only going to invest in New York City and the 5 boroughs, in projects like affordable housing that may have been damaged as a result of Sandy, and they'll put a fund together that's diversified, if you will, in the boroughs, but all the money would go into the city. So we'd be an investor with them. They'd be the manager. They'd fix up the buildings. They'd make a market rate of return on a risk-adjusted basis, and we would pick the right managers in theory. And there might be 2 or 3 or 4 of those kind of managers, and before you know it, the pension fund has helped rebuild the city by way of managers who were experts at that particular type of endeavor. So again, if you go to infrastructure, same kind of thing can happen.
Right. So maybe this conversation needs to occur, but maybe some thinking out of the box where all the funds maybe meeting with your staff down the road to talk about something like this.
I think a bigger question is, the city has to figure out what it wants to do.
Well, I'm sure they don't want to go under the water.
Been there, done that.
Yeah, I'm sure they want to fix, so that this doesn't happen again. It's my understanding that if we get a Category 3 hurricane or worse, we could lose quite a bit more than we actually lost compared to Sandy.
Absolutely.
So obviously, if global warming is like they say it is, we're at sea level. We can suffer some problems.
Yeah. But I think the city has to come up with a plan before the pension fund can do anything about it.
Yeah.
Right.
Just saying that they might have partners in the pension funds to think about that.
Yes. I agree. Okay.
That was just thinking out of the box. I apologize.
No problem. So that sort of ends Sandy. So let's talk about infrastructure, since you mentioned infrastructure. So I think in conjunction with the new asset allocation, which was probably June of 11, so we were talking about it for all of 11. One of the things we were going to talk about was infrastructure investing. And then I think around August or July of 11, we decided to, through an increase in corpus expense, to hire some people. So we've hired 2 people for our infrastructure team. Then once you have the people, you sort of need to have a plan. So the plan is the IPS. And we decided, sort of working with Barry, to sort of relabel what we call real estate and call it real assets. So we've expanded definition, and inside a real asset IPS, you end up with subcompartments. One would be real estate, one would be infrastructure, one in the future might be energy or timber, basically hard assets that are inflation protected. So we've worked up an IPS, and perhaps we should talk about the asset allocation in general, as to how we got there, what it looks like, what the benchmarks are. But ultimately, it leads to this IPS, which we'd like to get approved today. so that we can ultimately, to your point, Joe, we can start familiarizing ourselves with who's in the market, what the funds are. Again, since it's real estate, as you remember from the education that we had, it looks and smells a lot like real estate. So Townsend's been nice enough to work with us on the infrastructure things. So is Townsend coming? As has Cortland. Townsend and Cortland. As has Barry. Should we do Townsend, Yvonne, Townsend and Cortland lead it, and then Barry chimes in at the end? Is that how we do it?
Okay.
Yeah?
Yeah, we can do it that way.
Okay. Did you get this?
Yes.
Okay. I'll make sure she's got it.
Morning.
Good morning. Long time no see.
What was it, Friday? Yeah, Friday.
Was it Thursday and Friday?
Thursday and Friday.
Maybe you guys are ready. I did your intro.
You did it already? I'm sorry. I was waiting to hear that myself. We're here. We're going to talk to you about 3 IPSs today. Given the fact that it's 3 IPSs, I'm going to move fast. Feel free to stop me at any time you want. But I'm going to move fast because I got real assets, I got real estate, and I've got infra, which is a new asset class, okay? I'm encouraged by what you're doing. I'm encouraged by what you're thinking about. You're thinking about adding a new asset class. I'm sorry. You're thinking about adding a new asset class. That's a good idea, in my view. And I think that anyone, I didn't hear your general consultant's comments, but my guess is he feels the same way about this. I wanted to quote from you. There's an article. It's from JPM, but it sizes up why people are doing this now. And I've got 10 clients now who are moving in this direction. And we're helping them out with these things in the multiple billions of dollars. And it's about a 5-year-old effort at this point in time. Here's how they summed it up. History shows that secular changes in the investment environment force dramatic changes in asset allocations. Low bond yields, along with outsized equity market volatility and modest equity returns, have brought us to a new asset allocation tipping point. Global real assets, real estate, infrastructure, transport, and natural resource assets that can provide higher income than bonds and superior risk-adjusted returns to equities will increase in size and importance in investor portfolios. In the next decade, we believe real assets will move from an alternative to a mainstream asset class. Portfolio allocations could rise from roughly 5 to 10% today to as much as 25% in the next decade. I really believe that. I mean, that's not the Townsend Group talking. We believe that statement. It's from a manager. And obviously, managers have a vested interest in whatever their investment philosophy may be at that time. But that is the way of the world. That's what I've seen over the last 5 years. Let's go through this quickly. The Real Assets IPS is in your book at page 147. I have a flip book here for you. I'm going to talk from this first. When you see the reasons to invest across real assets are identical really to the reasons to invest in real estate. They're all the same. I mean, at the bottom of the page, on page 1 of the PowerPoint, what's the strategic objective? It's to preserve investment capital, provide a hedge against inflation, diversify the broader portfolio by dampening volatility, and provide attractive risk-adjusted returns. It doesn't change asset to asset class. That's what it's going to be for each one of these things. If you look at the next page, I think that's dispositive. Look at the low and negative correlations from real estate, infra, to equities, to bonds. Look at the low correlations between themselves. It's a good diversifier, period. And obviously you need that. That helps you in a downturn. It doesn't act like the rest of your portfolio. Inflation hedging, page 3. Same idea. We're in low inflation right now, so I guess the true test is when we go into a more aggressive inflation period. But if you think of, let's use real estate as the example, if you think of real estate as a good or service, a lease rather, when inflation hits, the price of that lease goes up. It's just that simple. It's the same in inference, the same in the other real asset classes, basically speaking. And I think that chart shows it. Next page, page 4 of the PowerPoint. If you take a look at that, I'm just laying out for you the different segments of the real estate universe, from opportunity to core to value add. We have listed infrastructure in here. When we talked to you last time, the private infrastructure indices, or we have a composite of it. It's a more limited data set, so we didn't put that in there. But we'll talk to you about that in a little bit too. But if you look across, this is 10-year study as of June 30. So that's a long period of time, and you can see where those stack up against the other asset classes. Again, further to the idea that it's a quote-unquote good idea. I'm now going to move to real estate, if I may. Gentlemen, would you like me to go through, I can go through page by page of this IPS if you want me to do that. They're not long, but you tell me. I can do it at the end, I can do it right now. If there's something in there that's really different, I'm going to tell you, and I don't think there's anything really different. The real assets one is new, so I encourage you to read it, obviously, thoroughly. But there's nothing remarkable to me. It's up to you. You want to go through it? Okay, let's get on the record with that then. On the real asset side, I mentioned to you before Roman numeral 3, strategic objective. Again, it doesn't change asset class by asset class. On the next page, we talk about asset allocation. This is important too. You have 6% plus or minus 2. We're going to basically use the real estate allocation initially. I fully and freely predict that in 5 years you'll have, and this is just me talking, you'll be at about 10% real assets. You'll probably, in all likelihood. You're plus or minus 2 now, you'll go to 8. I was in front of the UN Investment Committee in July, and that's what they did. They were 6% real estate, and they said, we want to do these other things. We're going to give ourselves about 4% of space. Go find us infra, timber, and ag. That's how they did it. 6 plus or minus 2. I think we're going to move with, Petch's group here to do a couple of infra deals with you in the near term, but we'll build that up. The role and responsibilities of the trustees, the comptroller, and the real asset consultants, these are basically the same. I've been with you 8 years now. These have not changed in 8 years that I'm aware of. Remember, when we get to real estate, and I'll highlight it at that moment in time, we have limited discretion in real estate. Do we have that in police? Do we have limited discretion in police for core?
We only for one deal.
For one deal? Okay. Maybe it's not as big a deal with the other boards. I would encourage you to read page 5 of the IPS, the exceptions to the IPS, how can it be changed, etc. With that said, I'm out of the real assets IPS, and I want to move into the real estate IPS now. We've been doing this for about 8 years now. We changed the program probably 5 or 6 years ago, and we said that if you remember in the beginning, it was 60 to 100% core. That was the deal. It moved, and we did that 5, 6 years ago. And we said no less than 40% is going to be core, no less than 40% is going to be non-core. And that's basically what we're trying to do. That gives you 20% in the middle that you can adjust tactically. Harder to do, because it's an illiquid asset class, but that's the intent, basically. We've modified this, and this is important, we've modified the documents in ways that actually, in my mind's eye, make it more restrictive to the comptroller and restrictive to the consultant. In other words, it's a better monitor, or whatever you want to call it. And I'll take you through those. At the bottom of page 5, I take you through basically what those are. We moved to a NCREIF Odyssey benchmark. Now, we actually did that about 18 months ago. We moved away from the NCREIF NPI because that was a huge unlevered index. It wasn't investable, et cetera, et cetera. The Odyssey is more realistic. Subsequently, we moved a little bit more, and we said we're not going to be just Odyssey flat. We're going to net it out, so it's Odyssey net, so fees and expenses are out, and then we're going to add back 100 basis points. So it's a good challenge, and you might ask me, why is that a realistic benchmark? And I think that's on the next page, page 6. We did a 10-year rolling backwards. We created a model portfolio, 50% core, 50% non-core. And if you take a look at those two lines, they're very close to each other, and that's a 10-year study. So that says to me that we're always kind of going to be right there. It's going to be a good challenge, but it's transparent. I think it's fair. I think we can beat it or match it or beat it. That's the deal, and that's what we're trying to do. On the next page, page 7, we used to have a rule which was property type geographic diversification was NPI, NCREIF, plus or minus 30. So if the NCREIF was at 30% office or 35% office, then I could go to 65 or 70% office. That's not really a real test, is it? That means I could take your whole portfolio in one direction or another. So what we did was we decided to cap this. We're just going to go up to certain levels. We're not trying to go off benchmark here. In all likelihood, we'll probably close to parrot the different property types and the different regions, plus or minus. But we're not trying to go off benchmark here, just so you know that. But we would ask you for the flexibility that if we saw a huge opportunity in an asset class or in a particular sector, we want to be able to do it. And I think this rule will do that for us. Debt limit, this is big. You know, obviously one of the biggest things you can do to mitigate your risk is control your leverage. Going back 8 years, we were at 50%. Why were we there? If you remember the first acts we took with respect to this portfolio, you had certain investments at that time. They were New York-centric, they were opportunity-oriented, and you had a couple of other op funds in there, so it was higher risk. But the first thing we said is, let's make this thing a little bit more conservative. Let's spread it out across the domestic United States. Let's do things like that. And in other words, quote-unquote, conservative. That's why we put a 50% LTV ratio on it. The realities of what we're faced with now is that we're going to tilt you. We're going to be about a 50-50 blend. I think in the near term, we're going to tilt you probably toward the non-core side. We're going to overcommit a little bit. Remember, those strategies are 75% leverage. So I'm going to be taking on a little debt there, to put it mildly. In theory, if we wanted to, you have a core plus sector. That means core plus basically is value added. We could eradicate all the core and go strictly value added. That would be 65% leverage. I'm asking for room. I'm not trying to lever this thing up. I'm going to try to keep it around 50. But the reality is it could move. And I don't want to have to come to you every month, every quarter and say, God, I'm 54%, and I'm not sure if I can bring it down to 50. It's an unrealistic, 50% is an unrealistic measure at this point in time, given where the portfolio mix is and where it's going to go. Diversification, again, we refined ourselves here. We took it down from 25 to 15%. That's just a manager diversification tool. So that's good, too. I'm going to turn over now to the IPS. The real estate program IPS, page 6. General approach, we've noted that. We have definitions here at the bottom of the page of what core is and what core plus is and what non-core is. Investment classifications follow, but importantly on page 8 of that document at the bottom, we have the following language. For purposes of this IPS, real estate includes but is not limited to. And it takes you through private equity real estate, but it also says we can do debt and we can do some other things, investments and REITs, etc. The reality is, if you're going to go into an op fund, you're going to get this stuff. I can't have a pure rule and say you'll never be in it. But also the reality is I want you to have the flexibility. You want to do a good debt investment, we're going to have one today. I want you to be able to do that. So are we purist? Is it going to create some tracking error for you? It might, but I'm not thinking, overwhelmingly, no. I mean, it's going to be there, it's going to be modest, and we'll watch it for you. All right. If we keep going through the real estate IPS, again, page 9, I think I've taken you through most of this. We have our property types. The other category, interestingly, I get asked what that is. It could be like student housing, it could be medical office, it could be land, it could be things like that. The idea that it would get up to 20, I guess it could, but I don't foresee that. And note too, we're building in an ability to go 25% international. I don't think it gets there, but you want to have, it's a global asset class, so you want to have a broad threshold in that regard. Next page, single investment size. We can't be more than 15% of the portfolio position. Investment position can't be more than 15%. Manager can't be more than 15% of the system. Leverage, we've talked about. Currencies there. And then we go through a variety of different, I think it's diligence tools, etc. And the objective, again, as it follows, would be the NAPREIF Odyssey net plus 100. That finishes real estate. I'm going to move on to infrastructure. We had 2 meetings with you. We had one meeting that dealt with, it was just kind of a one-on-one, and then we had another one, which was a strategy discussion, and we talked you through. So I'm not going to redefine infra to you. You know what it is. On the first page, a couple of basic things. This program is designed to start out conservatively, and I think it'll stay that way for quite a period of time. We're saying 60 to 100 in core infra, and maybe 40 in non-core infra. So it's not like we're trying to go out of bounds here or do something wild. This is a solid asset class, and I think it's a good time for you guys to move on this, to be honest with you. The second page of the PowerPoint is 11. It takes you through what core and non-core is and what we're trying to do. Pages 12 forward are probably more important because it gives you the nuts and bolts of what the program's going to be and how the limits will work inside of the program. And again, the big rule, I think, at the outset of this is going to be the 60-40 rule. And I think you're going to see us move in a conservative direction. The one thing I would caution you, this is a different kind of an asset class in that you could have a core infra deal with 90% leverage on it. It's just different. I don't know another way to put it. So we cap leverage here at 65%, but you got to know, we could be taking on the most core risk in the world, but they slap it's different than any. I'm not aware of another asset class that does this, but that's how it works. So just so you know that. But we'll watch that. We capped it at 65 across the board with infra. So I think that's fair. And, I'll look at this. The benchmark, what are we trying to get? We're trying to get a 6.5 net. What are we trying to do overall? A CPI plus 4. I wanted to ask Ishka to comment on the benchmark. I wanted her to comment a little bit on the return target for you. She works directly in infra with Mike Goldbeck for our office, but go ahead, Ishka.
So the benchmark for the infrastructure program being proposed is very consistent with one of the strategic objectives of the real assets program, which is to achieve some kind of inflation hedging or protection from investing in real assets. The benchmark is also consistent with peer practices. We can provide you with several examples of institutional investors that have adopted a very similar approach to benchmarking their infrastructure programs. Within Townsend's own client base, there are several institutional investors that in in the last 12 to 18 months have adopted, CPI-based benchmark for their infrastructure program. And also, as Steve mentioned, we will be pursuing, a large majority of the investments will be made in core infrastructure strategies. The benchmark is also consistent with this type of an investment approach. Most of the investments will be made in operational assets that have a long history of steady cash flows and can generate, a steady income yield. There's also return history to support this benchmark. Both public and private infrastructure investments have produced a nominal return, which when adjusted for fees and inflation over a long period of time, generate a net real return of what is being proposed today.
I want to take you through briefly. It's page 13 of the overall real assets. Now I'm in the infra investment policy. Investment operations are laid out on the first page. Then we talk about core, non-core. This is 60 to 100% core. The fact that we'll go through an investment plan, pacing, etc. And then, really importantly, on page 15, I think the risk management techniques that we'll use, most importantly, would be that 65% threshold, and also that basically that 60 to 100 core to non-core. I think should be important. The investment evaluation criteria. It's very similar. The way you diligence an infra deal is very similar to the way you diligence another real asset deal like real estate or any other. It's basically the same way you go about it. It doesn't change. And then the performance objective, which I think is realistic, CPI plus 4, a 6.5 net over a reasonable amount of time, I think we get there. So that concludes my formal remarks. Now, I'm happy to field any questions you might have about these things.
Before we talk about, before we approve this, we should hear from Barry as to how it fits in the portfolio a little bit.
Okay, there's a handout, and just commenting on the IPS, I think it's in a shape where it's ready to be adopted. I think, first of all, that combining it with real estate into a real asset category makes sense. However, the initial allocations of infrastructure are going to be so small that it won't warrant its own allocation target for a while, once it gets up over 1%, approaching 2% of the portfolio. I think, like real estate, it shares some primary portfolio objectives, which is inflation hedging, diversification, and access to the illiquidity premiums. I think in our work, we put it fairly close in terms of risk and return to real estate. You see the numbers there. I just want to make it clear that our risk, 18.5 for real estate and 25 for infrastructure, may seem high relative to what Townsend or Cortland would show you, but we are using public listed indexes to come up with that. So for real estate, it's NAREIT, and for infrastructure, it's a 50-50 blend of the Alarian MLP index, and MSCI has a global infrastructure index. So that's the historic volatility of the combination of those two. And you see their correlations to other asset classes are pretty similar. They do diversify the portfolio, and infrastructure does diversify a portfolio of real estate. As far as the benchmark goes, I agree that CPI plus 4 is reasonable, and the main reason is it puts you right between expected real returns on stocks and bonds, and that's right where it should be. So bonds have about 2 to 2.5% real return expectations, and stocks is 6. So for that reason, it's a sound benchmark. There is no unanimity on what the infrastructure benchmark should be. Of 9 funds that we know, we see 7 different benchmarks, and actually 3 of them have a CPI plus benchmark, and it's either plus 4 or plus 5. CalPERS is at plus 5. And then the others are sort of blends, but part of that blend is a CPI plus component, so it's reasonable. Back to overall allocation, if you look at the whole pension world, or in the U.S. at least, the last observation I saw was in 2010, and infrastructure had a 0.3% allocation. And a survey from Russell said by 2012 that will go up to 1.4. So it's relatively small, which is consistent with my initial comment. Now, as far as the core, non-core split, if you look at the midpoints of those ranges, it's 80-20, which I think is an appropriate, especially one of your objectives for the portfolio and the IPS is preservation of capital. And the core will probably preserve capital. The non-core, not so much. So I'm happy to see it weighted towards core, given the preservation of capital objective. I talk about some expected returns. I agree with Townsend's. Our number is very close to them. But if you talk to the managers, the core stuff is going to be 6 to 10, and the non-core stuff 10 to 16. So as usual, they paint a rosy picture. Going forward, I think as we start making investments, we should revisit this IPS and fine-tune it. The way a lot of people who have done infrastructure in a big way, and that would be mostly the Canadian plans, they view infrastructure as an ideal asset class to match cash flows from the investments with the benefit payments, because they're steady, they're predictable, and they are inflation adjusted, which is really how your benefits behave in the future. So I would like to see something like that added to the IPS. But overall, I agree that this is in shape to be adopted today.
Perfect. Thanks, Barry. Any questions for Barry? Any questions on the IPS?
Janice has a question.
Yes. In terms of benchmarking the total program at this point, since you talked about how it will primarily be real estate, it seems like probably the Odyssey Plus wouldn't be an appropriate benchmark for a real assets allocation. So what benchmark should we have for total real assets program? What do other plan sponsors do? What should we think about?
They do what's called a roll-up. So let's say your real estate portfolio is 90% real estate and 10% infrastructure. Your real asset benchmark would be 90% Odyssey, 10% CPI plus 4.
But how does that define what our risk-return goals are for the program from a policy perspective? I mean, certainly that's going to tell you what is reflective of how we're implementing the program, but how are we defining what our goals are from a policy perspective?
I think when you're defining policy, you would use the capital market expectations that your consultant comes up with, which are really based on historical behavior of the asset class. But for benchmarking purposes, you're looking at something to gauge your investment performance on it, and this blending, the roll-up blend would be suitable for that. So it's two different sets of...
Okay. So how should we incorporate that into the policy?
We should write it down.
I can write it down.
Barry will write it down. We'll add that.
I have one more question.
Sure.
And we have the statement in all of our IPSs about not entertaining investments that will have the potential to eliminate public sector jobs. And that doesn't really seem to have been an issue in the past, except now that we're getting into infrastructure, a lot of the investments that we might be considering might be, a toll road that was owned by a state that is now taken private by investors. So this is now going to start to come into play. And I wonder if this statement is maybe something we need to think about removing as it applies to infrastructure, because a lot of the stuff, frankly, we're going to be looking at is going to be, taking public sector jobs and making them private sector jobs. And it seems like this might actually interfere with our ability to invest in this sector, as we'd like to have a diversified portfolio.
I don't know that premise is really true.
I just don't. When you say it's going to take away, I don't know that that's factual. I just don't. I mean, where does that come from?
Sorry.
I just don't know where I don't know that that's true in every case. Listen, the public sector part of this portfolio, and that's kind of sacrosanct. We work to protect that. You're absolutely right. Could there be an instance where we couldn't go into a deal because we saw massive elimination of public sector jobs? You're right. And in that case and point in time, I'll come to these fellas and we'll say we can't do this for this reason unless you want to do it. And you're a fiduciary. You've got to make a decision. I'm with you on that. But I just, changing off an overall portfolio or a policy statement, and this came up in the last meeting, is I don't know. I don't know that that's right. I'm sensitive to your point because I think you're right. In infra, I think you're going to see this a little more. I think you're going to see it.
Yeah.
But I can't tell this board that that's an axiom. It's not, as far as I'm concerned. It could happen. If it happens, we're going to bring deals to you and we're going to tell you what that is.
Well, it doesn't seem like you'd be able to do that because this policy says that you would not even be able to entertain investments, which means you wouldn't even be
I think
able
the
to
language is
consider
pretty strict.
Yeah, it is pretty strict.
It is strict.
Yeah.
But I don't
So
see a reason why these guys would want to change it.
Well, what I'm saying is maybe we make it a little bit more consistent with what you've just described. I mean, what you're describing is that there would be a discussion with the board and say this represents a good opportunity from a risk-return perspective, and we would still like to do it. But the way this policy is written, it doesn't sort of even give you the ability to come to the board.
I don't disagree with you. I just wouldn't change the overall writing of a policy that's probably been there since before I was born. I wouldn't change it. That was only 20 years ago.
I don't know if it prevents him from bringing it up and say, this represents a good opportunity. Would you mind if we pursued looking at it to bring it at a later date for you? I don't think it prevents that.
It doesn't.
And I think at the end, I agree with him. I don't necessarily want to change the policy. As long as it doesn't prevent, I mean, we as a board can review something and determine that maybe it's something we do want to do. But I think the overall idea is that we're not looking to eliminate public sector jobs as a result of an investment if we don't have to.
Right.
But that's difficult, and language is very difficult to fit in every situation that comes before us. It's a case by case, and if we see something out there in the universe of investments, that could be something that we would look at or would fit and wants to bring it forward. Of course, bringing all the negative with it, that it may eliminate some public sector jobs, it may have some problems based on our policy. We can determine then if it's something we want to go forward with. It doesn't prevent the conversation.
And Joe, Janice is right. In this space, infra, we're going to cross this bridge. It's coming. Much more so than we do in real estate.
I think
because it's just,
we walk in with our eyes wide open.
That's it. That's all. And I agree with your point. It is very restrictive writing. I just don't like changing long-standing writing. I think you're right. We bring it up every time.
Well, then maybe what we can do instead of changing this is to add something like is in the new private equity policy that just says if there are any opt-outs, that if there are any opt-outs that happen that don't come to the board, that you will report those to us on a quarterly basis just so that we're aware of things that are going on behind the scenes. Because right now, things may happen where you guys pass on or decide to pass on an investment that we never know about as a board. So maybe we could add just some language that's similar to what we have in the private equity.
On that score, it is unusual that, with respect, I can only speak of real estate, that we ever opt out of things. It does happen from time to time. It's not a major change. We've gotten into this or talked about this before. So, I mean, I think that's a transparent problem. I think Van does talk about it at meetings. I don't. There's nothing going. I just don't want the image that there's something going on behind the scenes about opting out or something secret. That doesn't happen.
Right. No, I agree. But I think we should have just something in the policy that talks about monitoring and reporting. And I think since we've got something in the private equity policy, it would be good to have one in this policy as well.
I'm not sure where that gets us, and we're going to monitor possible funds that we're not investing in.
No, it's just there's some language in the private equity policy that says if BAM opts out of an investment, that it will let the board know that it's passed on an investment. I mean, sometimes we find out about these things, but it's quite a while after the fact, so it's just to provide us with some timely reporting on investments that we pass on.
I don't think we've opted out anything since I've been here the last 3 years, and if we did, or we're going to, since we're so transparent with everybody, we tell everybody that's how you want it to operate.
Right.
But to Steve's point, and you bump into it more here. It's funny you said when you cross that bridge when you get to it. I thought that was sort of a pun there, but you might buy that bridge. But again, if I look at this, we tried to keep this language consistent with what it was and not change it, because again, we're taking real estate, and making it real assets. So we took the real estate language, particularly as it related to this topic, and we're trying not to get into a philosophical conversation about the topic per se, because it's in all of our IPS. If you want to talk about reporting stuff, maybe we can stick that in the general IPS, and we bring that. That might be the place to put it, instead of trying to tweak it in each one.
Well, there's a lot of stuff in here that's repetitive of what's in the regular IPS, too.
It's all repetitive.
Yeah, I know. So, I mean, since I'm just trying to make it consistent with the private equity IPS, and since we are going to have more issues with it here with regard to infrastructure, it seems to make sense to include it in here, too. It's just the same language.
I'll leave it up to the board to figure out how, whatever you guys want to do.
What's the request?
Just to include reporting of opt-outs?
I don't see how that prevents anyone here from asking the questions, if that's what you want answered. I don't know if it needs to be put into the policy statement. If you want a question as to, Steve, were there any other funds that you looked at that, were requested not to be?
The only time we've run into, I don't think we've ever run into opt-out at least every year on real estate, or have we? It's been teachers because of countries. They don't want to go into certain countries. And I remember one deal, it was Poland. They didn't want to go into Poland. So we had to opt them out of a Poland investment. I think it was with Blackstone. I don't ever remember doing it with police. Then again, I could be wrong. And a good point was raised, Janice, you raised a good point. God, if you opt out of something, you blow up the whole strategy. And that's a great point. In this particular case, it was de minimis, so it didn't really matter. I don't remember ever doing it for you. So I don't think it's an issue. I don't think it's a big issue. And listen, if there's an opt-out going to happen, we're stopping something in a deal.
I think it will be brought to the board.
We'll tell you. I don't have a problem with that at all. The problem is, if you're going to do it, if you're going to have rules saying we got to get out of certain things, you got to let BAM have that authority, because we can't wait 30 days. Those deals have to come back.
Well, I think BAM would be knowledgeable enough to reach out to the trustees and let us know. They wouldn't just necessarily take it on their own. They would actually let the trustees know. Am I correct in that assumption?
That's how we operate.
So I assume that there wouldn't be, it hasn't come up, so I don't think that it's necessary.
I don't
There is a section in the real assets IPS that defines how you would handle exceptions to the IPS. That section does not repeat itself in the infrastructure IPS, but I think that would sort of supersede that. I think, as currently written, we have language to cover that. Now, I think, as Steve says, we are going to cross that bridge, because that's how infrastructure works. And when we do, maybe we'll be able to be in a position to agree on perhaps different language on that sentence that begins, "will not entertain."
When you see
Maybe
it.
then we'll be able to find a common ground.
When you see it, I think if you see it a couple of times, you'll say, gee, the business kind of works like this. I think you're right. That's a good way to do it.
I prefer to deal with that when we get to that bridge.
Right.
We'll see how it plays out, and then we can determine how we want to address that in the future.
Right.
To start working on that now. It may not come up even once we start investing. It may not come up for a while, depending on the investments we wind up seeing.
So how about we adopt it the way it is, subject to Barry's one change on the benchmark for the real assets? If you give me a motion, we'll do that.
Can we also add it to Barry's point about matching, well, not matching, but longer-term inflation-linked cash flows with minimum volatility? Thought that was a good point, actually.
You give us 2 sentences. Subject to those 2 sentences.
So, subject to the 2 requests or changes that will be made, make a motion that we adopt the investment policy statements. Real estate, real assets.
Right.
With real estate and real assets, yes. Second?
Okay, hold on. All in favor?
Chorus of ayes.
Thank you very much.
Any opposed? No. Okay.
Okay, since Barry Miller's not here, I propose that we sort of punt on the private equity IPS, because he's sort of the expert.
He threw you under the bus today, huh?
He really did. It's raining, you know, he doesn't come out in the rain very often. But he'll be back later. When he comes back, we'll go back. I guess. So that ends the public agenda, since we'll come back to that one later.
So make a motion that we leave the public agenda, public session, and go into executive session.
Okay.
Take 5 minutes.
Take 5 to break it down.
On the cameras.
Senator!
friend.
I tell you for a second, those Giants will have me wavering.
2, 1.
Okay, so we're going to go to page 121 in the book. We're going to spend the next few minutes on some recommendations we have for the private equity policy statement. So what I thought I would do is just go over on a high level the recommendations that we have, we think, to give a little bit more color and granularity within the policy statement. So the first area of focus is, again, on page 121, section 4, under strategic objective, section D. Just by way of background, the benchmark for the police policy statement was is currently the Russell 3000 plus 500 basis points, as well as there is a private equity benchmark, which is, and we've talked about this each time we talk about the quarterly, which is a private equity median type benchmark. And one of the challenges becomes when you look at the private equity benchmarks today is the quality of the benchmarks are not great, and that's why you see enormous amounts of swings in there. So in discussions with StepStone, your private equity consultant, the recommendation we'd like to make is to adjust the private equity benchmark. Again, important to note, we're only talking about adjusting the benchmark, not how we underwrite funds for our recommendations, but the overall reporting benchmark. And we feel that the appropriate benchmark to recommend is the Russell 3000 plus a quarter lag, with a quarter lag plus 300 basis points. The idea of the quarter lag is very simple, is that when we all are showing you your private equity returns, in essence they are a quarter lag, but with the current cash flows. So the base number you're using is a lag number, so we think using a lag number, you should compare it to a lag number. And then the idea is instead of a 500 basis point kind of illiquidity premium, that it should be 300 basis points. And with that, I'm going to turn it over to Mike McCabe, which we've just handed out a separate presentation, which is that StepStone presentation, to give you a little bit more color on the benchmark. Mike?
Thanks, Barry. So this is the document we're briefly going to walk through. Anyway, good morning. It's nice to see everyone again. Again, I'm Mike McCabe.
So those are the only changes to the IPS?
No, that's the first one.
That's the first change?
Yeah, that's the first one.
It wasn't in the book, it didn't have like a red line copy?
We sent the red line, I believe, under separate. I was looking at Thad, unfortunately he's not sitting in that chair.
Thad, what do you say?
He agreed.
He agreed. Okay.
Okay to go? Great. So the most important thing that Barry has mentioned is that the underwriting approach and underwriting standards for this plan are not changing. So simply what's changing is a policy statement that benchmarks the performance of the private equity portfolio relative to the public returns. And so that benchmark is the Russell 3000. The Russell 3000 is a barometer of about 3,000 companies here in the United States. And so it basically captures 98% of the investable opportunity here in the States and is therefore a comprehensive and what we believe a comparable benchmark to apply as a returns benchmark. The big question is about when investing in private equity, what should the premium be relative to the public benchmarks that compensate an investor for being locked up in a private partnership for 10 years? And that's constantly under debate. There is no scientific answer to that question. The way we get to the answer is, well, what is the overall strategy? What are the various funds that are being approached? And what is going on in the market? So what we'd like to do is just share with you where the benchmark has been in the past and where it's going in the future very quickly. The policy today is about 10 years old. And so if we were to rewind the clock about a decade to 2003 when the policy was written and look at the returns in the public sector and the spreads over those returns, you would find that over the last decade, returns have compressed significantly. Simultaneously, this pension plan has grown, and its investment and allocation into private equity has grown. And as such, it's investing more capital. And the portfolio construction is evolving as more capital is being deployed. So there are two things going on. The construction of the portfolio is evolving, and the returns in the public markets are evolving. The confluence of those two elements are what we're utilizing as the rationale for proposing and recommending a change in the benchmark spread, which is currently 500. We're proposing reducing it to 300. More specifically, if you look on page 4, the public market returns have been shown both in Russell 3000 historical returns as well as U.S. Treasury yields. Again, if we were to take the clock back to 2003, when this policy was written, you would see the 8-year return, which is about the return you want to use for private equity, was about 9.25%. Applying that same methodology rolled forward to December of 2011, you can see it's about 4.05%. It's the 8-year return number on the chart on the left-hand side. So there's about a 520% reduction in overall returns from the Russell 3000 during a comparable period. Treasury yields are showing a very similar spread. During that 10-year period, as the public market returns have compressed, the private equity asset class as a whole has grown, which is shown on page 5. You can see from 2000 to 2012, the number of new private equity firms formed during that period is quite significant. And in fact, the amount of capital being invested is nearly doubled year over year. And so what was once a nascent asset class and somewhat of a cottage industry is now a massive asset class in the hundreds of billions of dollars. On slide 6 and slide 7, what we're showing are the performances of both private equity and venture capital. The takeaway from these two slides is, as the asset class has grown, competition has increased, you can imagine returns are coming down. Prices are being paid at a higher level. Credit is available, but not as available, and not as much leverage is being used. And the venture capital space, I think we've all seen what's going on in venture capital as promises and expectations continually remain underwhelming and over-promising and under-delivering. So what we're moving into is slides 8 and 9, showing that on slide 8, there is a spread of returns across private equity and venture capital, whereby you'll find in venture capital the highs are higher and the lows are lower, and as funds get bigger, that a very important characteristic prevails. The bigger the funds, the larger the check sizes, the lower the loss probability, and also the lower the upside probability. So there's a risk-adjusted result as an investor scales up in this asset class, which is exactly what police is doing, as many other large public pension plans are doing, which is what you're seeing on slide 9. Slide 9 shows the annual pacing from this plan into private equity, showing that the commitments from 1998 to 2004 averaged about $95 million per year. This has increased to about $370 million per year. What that means is we're investing in bigger funds. We're moving away from venture capital. We're moving away from smaller funds where higher returns, a larger spread, if you will, over the public benchmarks are more readily attainable than the larger funds. So these 3 or 4 factors are confluencing into a recommendation that as public market returns are compressing, this plan is scaling up, moving into bigger funds, moving away from smaller funds. We'll also see a smaller spread over the S&P 500 and the Russell 3000. And that basically is a high-level summary of some of the research that we've done, some of the analysis that we've done with staff and with our own group. And importantly, on slide 12, what you'll find is across all of StepStone's clients, you'll see that there are a number of similar benchmarking recommendations that have been implemented, ranging anywhere from 100 to 500 basis points over the Russell 3000, depending on the size of the plan. The smaller plans who can invest in the smaller funds and some venture capital will have the 500 spread. There are other plans that are larger than New York that won't even touch a fund under $1 billion. that will probably use the 100. And then police somewhere between those two is what we're recommending at a 300-point spread above the Russell 3000. So with that, I open the floor to any questions or comments.
Great, and then we'll continue going through the policy statement. So if we go in the book, which is to page 122.
So I'll just, real quick, I'm sorry. So here, it would just be 10-year average Russell 3000 plus 300 basis points.
With the quarter lag.
With the quarter lag.
Correct.
Not 10-year. That's what it said.
No, it rolls with the, right, it rolls.
It rolls.
So it's a rolling 10-year average.
Yeah.
I just want to make sure. With a quarter lag.
With a quarter lag plus 300
basis points. Correct.
And with that, we'll go to page 122. So there's some language that's been added in here about emerging managers, and this is language which is from the EM 2012 discussion we had back during the summer, which is really...
But unfortunately, I didn't get the red line, so just point it out as you go along.
Yeah, absolutely. Second paragraph, page 122. It says the fund seeks to employ emerging managers, so that's new language. If we define on the bottom what the emerging manager language is, and this is from the EM 2012 presentation that we gave during the summer, it's really just defining what emerging managers are. So that language is new. Then under Section 5, asset allocation, there's a box there that says strategy. By way of background, the previous IPS really had four categories. So you had buyout, you had venture, you had distress, and you had other. Those were the categories. Within those categories, there were individual allocations. If we go back to October when we made the recommendation on the tactical plan, because the IPS hadn't been reviewed really since 2005, the idea was the tactical plan, because that is an annual plan, that the individual allocations would go into the tactical plan as opposed to the policy statement. Again, this is a tiny bit backwards because we have the tactical plan already approved, so what we've done is we put that granularity, so buyout, growth, special situations, energy, secondary, co-invest, and other. Now we've included those in the policy statement, so on the tactical plan, these will be the categories that will be utilized going forward. It just gives you more granularity, you get a better idea of effectively what you all own.
So we're just expanding it from the three.
Correct. If you go to, make sure you give me the right spot here. If you go to page 123, the bottom bullet, that again is just the emerging manager language, just talking about the program. Again, this is language taken from the EM 2012 presentation about how that's going to be implemented. Only a couple things left. If you go to, if you go to section, go to page 6, section D, number 2, where it says co-investment in direct secondary. So historically, the police board had the ability to invest in secondary funds and to invest in co-investment funds, but didn't have the ability to invest in a direct co-invest or a direct secondary. So the idea behind this is really to have more tools in the toolbox. But again, it's very important to note, this is not asking for discretion. This is, if a direct secondary comes up, if a co-investment comes up, we still come to the board and we ask you for your approval. But from a legacy standpoint, you just didn't have that tool in your toolbox, so we thought it was important just to give you a little bit more flexibility. If you go to section E, which is exceptions to the IPS, so it was interesting, so the way the legacy policy statement was set up, there were things you could do and things you couldn't do. But there weren't really any remedies set up for if in fact you did something you weren't supposed to do, what would happen. So the idea here was to kind of put remedies in here so you all would be notified. So we thought that was important. And then finally, if you go under risk management, section C, and this goes back to what Mike touched on before, which is as the system has grown, both from an asset standpoint as well as an allocation to private equity, we thought it was prudent to really talk a little bit about the size of the commitments that you made. Again, Every commitment is brought to the boards, and you all ultimately make the decision whether you want to approve it or not approve it. But we thought it was important to just give you a little bit wider band, because as your allocation has gone up, the size of your fund has gone up, there was still kind of a legacy small number, so we thought this was important. And those are the high-level changes that we recommend to the system. And as I look, which I probably should have said before, if you go to page 131, Joe, actually there is, it's kind of a, I call it a black line, but it's basically one, I would have said it's a red line. So everything is in there, but we moved lots of things around, so that's the problem with the red line version, if you just move something. But those are the high-level changes that we're recommending to the boards. And with that, we'll leave it open for any questions that people may have. Justin?
A couple questions. So on page 122, the asset allocation table. So in the past, sector ranges were defined, or there were ranges around them, and that, you know, what served as a proxy for the risk expectation of the plan. I guess now that that's gone, could we insert some sort of language just so that we have a sense of risk expectation?
Well, it's not gone. Again, it's not gone. We've moved it out of the IPS into the tactical plan, which was approved in October, because the idea there was that the tactical plan per the IPS gets reviewed every year. There's no formal statement that says the policy statement needs to be reviewed annually, every 2 or 3 years. So those risk metrics are in there. They've just moved to something that's reviewed on an annual basis.
I guess that begs the question, though. I can see that, you know, there's going to be a certain amount of nimbleness based on market opportunities.
They're ranges.
But as far as long-term policy, you know, capital market and asset allocation decision-making goes, I mean, we have Russell 3000 plus 300 basis points as a long-run return objective. It would seem to make sense that we also should have a long-run, you know, risk expectation. I guess I'd ask, you know, Stepstone, how do other plans handle it? Is it the volatility of the Russell 3000 plus 300 basis points? Is that, I mean, that's just I'm throwing that together on the fly, but sure. I mean, what do other plans do?
So we serve a number of plans around the country, from some of the largest to some of the smallest. The convention is to have asset allocation by strategy. It's very unusual to find policies with numbers in them saying X percent will be allocated to Y strategy within alternative investments. That percentage is, and we've gone through all of them, by the way, since we had spoken about a month or two ago about this. We've gone through all the policy statements across our clients, and it's very unusual to find a number in the policy. You have, the reason there's an annual strategic plan review is to do exactly that, is to set a target. And even within the strategic plans, you'll find that the targets are a range, because it's hard to know a year in advance what the opportunity set will be in any given year given the market conditions. So the ranges and the numbers as to how much would be invested in Y strategy is often deferred to the strategic plan that is also approved by boards and not applied discretionally or unilaterally by staff or consultant.
I guess, you know, I bring up, is it just boils down to how does the board evaluate the success, the long-run success? So we have the, you know, it can be rather fluid from year to year which sectors are chosen, but it takes a few years to gauge the return, the relative performance. And I'm just throw out hypothetically, our benchmark is Russell 3000 plus 300 basis points. Well, maybe on a just absolute return basis, we're Russell 3000 plus 400 basis points, but if we don't have a sense for what the volatility is, it's hard to really gauge if, you know, if that is success or if it's just because we took a bunch of risk and risk was rewarded, or vice versa, you know. So I'm wondering, you know, how plans go about measuring the long run success beyond just simple, you know, performance evaluation.
Well, there are two metrics that Barry had alluded to, which are the public and the private benchmarks. So Thompson 1 is a benchmark for private equity funds. And so what we can do is we can benchmark the performance of this private equity portfolio by strategy against the private market returns in both a median and quartile basis of ranking within Thomson One's private equity construct. But again, that's not talking to volatility, which is, I think, the essence of your question. At what marginal rate of return are we taking on a marginal measure of risk? So what is the risk adjust? What are we pursuing in terms of risk in pursuit of returns? In private equity, you would find that volatility is what this plan is pursuing, which is not a lot of venture capital, in fact none, or de minimis, is low. So volatility, you'll find, is quite low on a relative basis and not easily measured as it is in the public markets. So we won't find too many volatility calculations, and my partner Kristen DePlatchett spends quite a bit of time on this as well, and if there's anything you'd like to add to that.
There's no unit of risk.
There's no unit of risk that's being measured
about it.
the way the Sharpe ratio is used in the public markets or something like that.
I would just add, I know you're, I think, speaking to kind of system-wide or private equity per annum, but, I would say at the fund manager level, one of the most important analyses that we do, and, I think a number of the funds that we're speaking about today with respect to volatility is understanding loss ratios and, understanding, when a manager invests and they're consistently doing, call it 2 times invested capital, are they writing off a third of their capital to do that, or are they writing off 10 or 12% of their capital? So I think when we do our underwriting on each individual GP, that's really a central tenet of what we're focusing on. And we spend a lot of time, when we look at buyout funds, when we look at distress funds, understanding what the opportunity set is for you all to invest in these different managers and how each individual manager stacks up to its peers with respect to loss ratio, which is a good kind of GP measure of volatility.
Yeah, I understand. Obviously, there's a lag with reporting performance, and the valuation quotes, portfolio or fund valuation is pretty limited. So, market volatility measures won't work, but maybe it's a drawdown or some sort of break-even objective, minimum drawdown level that, serves as a risk measure. I don't know, I throw it out there just, so that...
Okay. Well, we'd be happy to circle back and understand in more detail what it is we can help with in terms of analytics here. But as far as other pension plans in the United States are concerned, the policy statement usually has strategy. Rarely do we see numbers saying X% investing in Y strategy. These policies are meant to sustain some periods of time without a lot of change. The annual plan is changed on an annual basis.
Any other questions?
One other, and we can take this up later in the meeting, but with regards to currency risk, we don't define it at the individual asset class level, but I think that there's more nuance coming to the board on some of these things that would be helpful in private equity. For example, when we go into a new vintage that is several years from being called out, from having all the capital called, maybe that's a good opportunity to take unhedged currency exposure. But, when we're buying secondary funds that are pretty mature and they could be harvested within a couple years, does that influence the currency risk decision? Because as you shorten the time period, it just becomes more of a wild card with currency. I think it's pretty safe to say that I'll open this to our general consultant, but currency risk, becomes quite a wild card over shorter periods, and do we want to differentiate and make a distinction for that in the in the IPS.
So I make a couple quick comments. If you look on the secondary side, so the 4 secondary managers that the police retirement system have, they're all denominated in dollars. So if you look at even the European funds, use AXA Private Equity as an example, that's a dollar-denominated fund. So there is no kind of currency risk that's taken from the LP's perspective. All the currency risk is potentially inside the fund, so that would be one. I think the second comment is with regards to the overall portfolio for the police retirement system. While yes, we have recently made recommendations to non-dollar denominated funds, so really euro. So if you look at the recent ones, it would be, again, it's all publicly disclosed, BC Partners, EQT. It's a de minimis amount if you look at the overall size of the retirement system. And the biggest challenge with private equity is that it's difficult to tell when the drawdowns are going to be. It's difficult to tell when the money is going to come back. So the reality is, if you look at what other pension funds do with regards to currency, and we've actually talked to other pension funds, exclusive of one, I would tell you that they don't hedge currency. And the only fact that usually comes out of those, when they do hedge it, they're usually on the wrong side because it's very, very expensive to do. And the reality is, if you're building a portfolio, you're most likely better off just to let it float.
I mean, yeah, I think there's a pretty sound basis for the argument that if it's a long-term investment, that it's a wash, or there can be diversification benefits. I guess the secondary funds you cite, is that just the GP's individual policy to hedge away currency risk? Are we going to get
no, what I'm saying is they're dollar-denominated funds.
All secondary funds?
Well, the 4 funds at the police retirement system are all dollar-denominated, whether they're U.S. or non-U.S. They're all dollar-denominated, so there is no currency risk to the LP. Any potential
That is not quite right. There's currency risk to the extent that they buy a euro-denominated fund.
No, but with regards to our commitment is X.
Right.
We're only going to pay in, if it's a $70 million commitment, you pay in $70 million, the money comes back to you. So in dollars, out dollars. So there is some flexibility on the valuation within there, but the LP's perspective is dollars in, dollars out.
So this is kind of a legacy issue that we could in the future consider secondary funds that maybe don't have that policy. Is that true? And if so, do we want to establish some sort of plan policy?
No. Simple answer is no. We don't want a plan policy. To the extent we want to hedge things, we should talk about it overall for the portfolio as opposed to investment plan.
Well, that's what I'm getting at. Do we want a policy on?
We could have a conversation about that in the general IPS.
The fund has consistently been, until non-U.S. currency exposure gets above 40 to 45%, we should not put a policy of hedging in place. Because of the basket case, we're nowhere near that. And I think any currency
It is a basket
exposure, any exposure to foreign currency we can get serves as a valuable hedge to imported inflation, the costs that our imports are going to go up, which is a big part of consumption.
Can I just ask a question? We have a 25% limit in the real estate investment policy about investing outside of the U.S. geographically. And so why don't we just simply have a 25% limit in the private equity IPS and just be done with it?
Well, in real estate where the land is, you have no idea where the investment in the PE firm is going to go. So if you have money in a global fund, you don't know where it goes. You commit to it and don't know where it goes, so I'm not quite sure what a limit would do for you.
35% then? Just
No, but I don't know what it does for you, other than it's a number on a piece of paper.
It just controls as a dollar-denominated investor, since we don't currently have any currency hedging policy, it just controls another aspect of risk. And in real estate, there are funds too. I mean, we don't have any control over where they invest, yet we have a limit there. So I guess just trying to be consistent with how we approach other private markets.
Well, that's the board to figure out what wants to do. It doesn't. I think we're less than 20% international, right?
It's de minimis right now, and to track what is where they're located, where they do business. I mean, there's so many pieces that go with that. These are global firms, so I think it's going to be a challenge to give you something that's meaningful that will help you get a better gauge.
Just based on your statement, you just said if we have more than 45% of the total fund, we're not even close to that.
Private equity is only 7, so if you look at that, it's so de minimis.
But that's not actually in our policy, though. That 40 to 45% isn't in our
No,
policy.
it's advice we've rendered to the fund 3 times that I can remember.
Yeah, but it just never makes it into policy.
And that could change suddenly if world economies, shift or whatever, right?
It's been, I mean, what would have to change would be consumption patterns. Because what you're trying to hedge is how much of what you eat, drink, smoke come from outside of our borders.
So with regards to, so this is the private equity IPS, which I think we kind of just veer it back to that. It sounds like if there's discussions on that, that might be separate. So the real question is, are there any more comments on private equity? If not, we'll turn over to you all for a motion of some sort.
It's worked for us fine for a while, and changing that suddenly. I'm always wary of the law of unintended consequences.
I think just putting together a study to evaluate kind of vet the currency policy. I understand hedging imported inflation, but there should be some parameters. If we just put all that 45% in euros, are we hedging our, so there need to be some rules and boundaries as to how we go about it.
Okay, we're working on it.
Okay.
But we're not even close to that. Would it make sense to just
about 17%?
Would it make sense, like, if we hit a larger trigger point, like 30%, to start having them do that? Because at the end of the day, we're not even close to 45%, which is what they're concerned about, if anything.
Well, you think that's nearly 20% of the fund there, and currency volatility can, it's not necessarily correlated with some of the asset classes you're in, so that's a whole other 10, 15, 20% of volatility, and if you're going to take that volatility, I guess there should be, it should be established that it's hedging whatever risk that you're trying to take. So what if it's all in the Canadian dollar, I don't know, or throw something out, the Argentinian peso? Is that doing what we want it to? I mean, that's kind of an extreme.
Right now, it's as diverse as the EFA or the all-country list, because that's basically where our international equity investments are, which is probably 95% of our currency exposure. So I can tell you, it is very diverse.
So 95% of the 17% is worldwide.
Yes, in line with the capitalization map of the world.
And no concentration. I mean, let's say maybe 2% of that is concentrated somewhere. Very close. Barry?
Yes, so that I was just going to say that again. So with regards to private equity, if we get a motion to adopt the policy statement?
We can't make a motion to adopt the policy statement for private equity.
Second? LBA, all in favor?
Aye. Okay, that ends again our public agenda.
Motion to leave public session and go back into executive session.
Thank you.
Thank you.
Thank you.
No, thank you.
Thank you for thanking me for thanking you.
So we're going to go back to the original